All right. Yep. So the first 2 weeks we talked about the first four financial lessons. We'll recap that in just a minute. But today we're going to talk about credit and how it's an advantage to manage your credit well. Of course, it's a good financial tool for our financial toolbox. So I'm going to go ahead and share my screen. Feel free to ask questions. If you have a question that pops up, I'll be more than willing to answer the question, or if I don't know the answer, I'll get the information for you. All right, so excited to talk about it. Thank you for joining me. All right, so I like to sometimes start a discussion with a humorous comic or some type of quote. So this is a gentleman here. He thinks that his being in debt is helping show his support to the country. Because he's in debt. He's like, the government is in debt, so we're all one happy family. Well, of course, it doesn't quite work that way. All right. So over the last couple of weeks, we've been talking about different things, different topics, different items that COVID-19 has exposed. These are things that have been going on before COVID hit. And now we're like, okay, all the water is gone out of the pool. Who was skinny dipping? And it shows who, right? So this pandemic has exposed the need for, and we talked about these in the last couple sessions, setting SMART goals, creating a budget every month, building an emergency fund, and understanding how much debt you have to repay. Now I'm going to go back to that emergency fund real quick. A lot of times the financial counselors suggest 3 to 6 months for an emergency fund. And back in March, that was about 4 months ago. If you were downsized or, there was some uncertainty with your job, if you had a good emergency fund, you would have been a little more secure than someone who didn't have an emergency fund. It's also exposed, and this is what we're talking about today, how people have been managing their credit. So credit is just a tool, right? It's a tool in your financial toolbox. Now, let me throw this disclaimer. You don't have to have credit in order to be financially successful, okay? If you can pay cash to buy a car, like Jason, you're going to pay cash to buy a car. If you have cash, even to purchase a home, it might take you longer to reach that goal. But as long as you have that goal set and you know how you're going to, set aside money to pay cash for something, by all means, okay? But not everybody can pay cash for a home, so they need to use credit as an advantage. Also in this toolbox, we have our budgets, we have our SMART goals, emergency fund, we have investments, our 401k, our other IRAs. We also have insurance. Those insurances are health insurance, car insurance, renter's insurance if you're renting an apartment, homeowner's insurance if you have a home, life insurance. All these things help us to be more financially sound. So again, credit is a tool that can be an asset if we handle it well. It can also be a detriment and cost us a lot more money if it's not managed well. Okay, so what is credit? It's the ability of a customer to obtain goods or services before making payment. It's a promise to pay for something that you have now. It's a promise to pay for it in the future. So lesson 5, understanding how to manage credit well. So during this pandemic, many people are using credit cards specifically, to supplement their income. So maybe that the job that you were working, maybe you had a full-time job and a part-time job. Maybe that part-time job went away, and maybe that part-time job was bringing in $200 to $300 a month. Well, So some people are using their credit cards to supplement that $200 to $300. The red flag in that is being able to pay that back at the end of the month when it's due, or being able to at least pay the minimum amount to make sure your credit is still handled well. So the answer to using credit to paying for essential items, those essential items are food, shelter, transportation, utilities. Sit down and take a good look at your budget. See where you can maybe cut costs to make up for that $200 to $300 that you're not getting in anymore, or find some creative ways to bring in some more income. Maybe it's like, Dave Ramsey always says, delivering pizzas on the side, Uber Eats, DoorDash, Ship Shopping, something that is still you're comfortable doing because you're not too worried about the health ramifications, being out around people, but you're able to still get that income. You need to know what your credit score is also, what your credit report represents about you. The difference between a credit score and a credit report, and we're going to talk about that in just a minute, and how taking control of them will be an asset to you right now. Any questions so far? Good? No news is good news? Okay.
No, I actually read that in that book, April, yesterday.
Oh, okay. Okay,
So,
cool.
all right.
We're on the same page. I'm not speaking crazy.
Nope.
Okay. Okay, so what is a credit score? A credit score stands for the Fair Isaac Corporation. It's one of the most respected companies that calculates a person's credit score. It is just a number. It's a 3-digit number. And it's calculated based on the information in your credit report. So you could have Nancy walking down the street. The number floating over her head is 624. You can have a David walking down the street. The number floating over his head is a 720. You could have Emily walking down the street. The number above her head is 840. Okay. So basically, this is just a quick way for lenders to determine how likely you are to repay a loan. And these credit scores go from, at least with the FICO score, the lowest score is 300, the highest score is 850. So how likely are you to repay a loan? The higher your score, the more likely you are to repay it. They can extend you more money. The interest rate is low, and they might give you a longer period of time to pay off that loan. If you're a little more risky because you have a lower credit score, instead of offering you $2,000 on a credit limit, they might only offer you $500 until you can show that you are credit worthy. Okay. So here we have a slice of the pie, or we have a pie chart, and that's one of the most visual ways to show how credit scores are being represented. So you're sitting down at your dinner with your family and you're having dessert. You bring out this pie, there are 5 of you, okay? The lucky people are going to get the bigger slices of pie, right? So the payment history represents 35%, and the amount owed, 30%. So 65% of this pie is going towards calculation for your credit score. We're going to talk about each one of these, each category in just a minute. But that's a huge amount. That's over 50%. So when we talk about how do we repair our credit score, those factors are big factors in that. Then you have length of credit history, 15%. And then the last 2, new credit and the type of mix you have, those are each 10%. Okay, so payment history, 35%. This is how have you paid your credit accounts? Have you paid them timely? Those people who have high exceptional credit scores, they probably haven't missed a credit payment. They've probably paid those minimums and even more than minimums every month. Okay, this doesn't necessarily mean that you have money in the bank if you have a high credit score. It just means that you're responsible with the money that you have borrowed. Okay, so you want to make sure you keep all your accounts in good standing. So when you're looking at a credit report, it's showing current. That's what you want for your credit accounts, to be current, not to be past due. Amounts owed, that's the 30%. All right, so just because you have a lot of money available to you with your credit card or lines of credit, that doesn't mean you have to use all of it. Because if you do, if you're using close to or all of it, it's showing that you're possibly overextended. And why are you overextended? Are you trying to keep up with the Joneses here? Or are you, is there an issue with your income and you're trying to just make ends meet using your credit? So there's this phrase, it's called credit utilization rate, and you want to keep that below 30%. So what is credit utilization? It takes the amount of available credit that you have available to you, and you want to keep that below 30% every month. So for example, if all of your available credit is $1,000, you want only 300 of the balance that you've used to roll over to the next business billing cycle. Now, ideally, you want to pay all of it off. But if you're in this credit game where you're trying to rebuild your credit or build your credit, you want only 10% to roll over. So you want to keep that amount owed as low as possible. Okay. So you use your credit card to buy gas or to buy, some small things just to show that you're using your credit responsibly. You want to go ahead and pay that off every month. But if not paying it off, make sure it's below that 30%. So those two huge pieces of the pie, amounts owed and your payment history. But then we still have another 35% to deal with. So it's the length of credit history. That's 15%. How long had you been in this game with credit? If you're just getting up to the plate and you within the last maybe 6 months, you're not necessarily risky because you haven't paid things back on time. No, it's just that you're new. So lenders need to see how well you're going to be paying your credit off. So you might have not as good of a score as somebody else who has a longer credit history, of course. So somebody who has had a credit card for 10, 20, 30 years, and they're using it responsibly. So the FICO score takes a few things into account: how long your credit accounts have been established, how long specific credit accounts have been established. So if you have a mortgage, if you've been in your home for 10, 12, 15 years and you're paying that on time, that's an advantage to you. How long has it been since you've used certain accounts? Let's say you have a credit card and you stop using it. It's possible that that creditor might close that account. And if it closes, let's say that was a long-standing account, but it closes because you're not using it, then that cuts the length of your credit history. So you want to keep that in mind. And if you still want to keep that card open, just use it on small things and, pay them off every month. Okay, new credit, the last couple slices. So research shows that opening several credit accounts in a small period of time represents a great risk. When do people do this? A lot of times around the holidays. JCPenney says, oh, open up this credit account and you can get 20% off. And then you go to Kohl's and you do the same thing. And you go to Macy's and you do the same thing. So creditors are asking, why are you doing that? So you want to be careful that you're not trying to open up a bunch of accounts just to purchase a lot of items that is going to be a struggle to pay back, in the new year. Limit your new accounts to just 2 within a 2-year period. So, but let's say you're looking to purchase a home, or let's say you're looking to purchase a car and you go to 5 or 6 different banks. Well, you have a shopping window to be able to do that. And depending on if it's purchasing a home or purchasing a car, you get a certain amount of time where you can go to these different banks and they only count that as a one inquiry and not as a whole bunch. Okay, so that's very important to keep in mind. And then the type of credit. Are you just a person who has a bunch of credit cards or a bunch of retail accounts and no other accounts? So that might be a little bit of a detriment, even though it's only 10%. Still, it's something that that they take a look at. So you want to have a good mix of, maybe you have an installment loan, which is your car payment, and you have a mortgage, and you have maybe one credit card, and you're managing all those well, paying those off on time. You don't need to have each one. You don't need to have one of each, but the ones that you do have, just keep that in mind. A lot of people also have student loans. Are you managing your student loans as well? Okay, and paying those off on time. Okay, so I mentioned before, the lowest score is 300, the highest score is 850. So this chart here just shows 66% of Americans, and this was, I think, a couple years ago, have a good FICO score or better. So good starts at 670, going up to 850. So again, keep in mind, just because somebody has a very high credit score doesn't mean that they have money in the bank. Okay, you could have a high score and have no money in the bank. So you want to make sure, if you want to stay in this credit game, you manage your credit well, but you're also building wealth and putting money in your savings account. Okay. Woo. All right, take a breather. Are you okay? This is my little stick figure. Any questions?
I have a
I can hear you a little bit, Rashida. You're breaking up a little bit. Do you want to you want to type your question in the chat, maybe?
Okay,
Oh, there you are.
can do that. So you hear me now?
Okay, it's a little better, but it's still in and out.
I'll type it.
You'll type it? Okay. I'll see if I can look at that too.
Okay, while she's typing that, can I ask
Sure.
a question real quick?
Mm-hmm.
Now the score, the FICO score, is that different than your credit score?
So the FICO score is a specific type of credit score. There are other companies that have credit scores. I think Vanguard might be one, but FICO score is used a lot. It's one of the major companies.
Like when I was attending the Momentum Term 47 stuff and we got on this topic, the paperwork that you printed out with that score, is that the FICO score for me?
Yes.
Okay.
Yep. And so those scores that were printed out, those are from 3, and I think we did 3, if not 2 of the 3, but the top credit bureaus, TransUnion, Experian, and Equifax. Yep, but they use the FICO score.
Yeah, because I thought I was kind of in the poor range, but I don't recall. I want to say I thought the numbers I remembered were like 600 something. I thought.
Oh, okay. So that's not bad. Yep. Okay, let's see what she wrote. With a credit card that you are using, how soon do they close the account? Okay, good question. I think it just depends on the company. So you mean, Rashida, like if you haven't used it in a while? This is what I'm guessing. Oh, there we go. Right, okay. So I think it depends on the company. It might take a year for them to close. I would recommend just giving them a call, calling customer service and saying, hey, I haven't used this card in about a year or a year and a half. What are the odds that you close this? And just see what they say. Yep. All right. Okay, here we go. Okay, cool. Okay, so let's just keep on going. And I know some people have things they have to do at 3, and that's fine. All right, credit scores versus credit reports. So a credit score, again, is just that 3-digit number. Credit reports is your report card. It's a profile of your financial history. How well have you been paying your credit accounts every month, keeping your debt load down, your length of your credit history, opening up new accounts. How are all those fitting into your mix here? And so the credit report, if someone were to print out your credit report, it shows lenders, landlords, employers sometime, utility companies, phone companies, how you've managed money, and it helps them to decide if they're going to extend you business, if they're going to extend you credit or not. So it contains not only your credit history, but these credit reports also show things like if you've had any bankruptcies. It shows unpaid bills. It shows credit card usage. Everybody has a credit report who has had credit extended to them. So if you have a mortgage, even if you're paying your mortgage on time and you're current, you have a credit report, and it prints that information out. It also shows, your credit report also shows where you've worked in the past, if those companies have reported to a credit bureau. Again, those credit bureaus are TransUnion, Equifax, and Experian. It also prints out different addresses you've lived at in the past. So if you pull your credit report and there's an address that's incorrect, you can dispute that to get that off your credit report. You want your credit report to be as accurate as possible. If it's showing a place where you've worked, where it says you worked at a certain place, but you didn't, you might want to take that off of, or have that taken off of your credit report. It could also be an indicator that you could have, that someone stole your identity, if it's saying that you worked at a certain place where you've never worked. All right, so you can go to annualcreditreport.com and get free annual credit reports from those top 3 bureaus. You can get it once a year for free. And I think even right now during COVID, I think I saw somewhere where they're offering more credit reports to people without you having to pay for them. If you're a Momentum grad, I can pull your credit report for you for free. It's a soft pull. It's not going to be a detriment to your credit. If it's showing again that there's some information on there that's inaccurate, you want to make sure that you get it disputed, and they give you the address on the back page of your credit report of where to write to dispute information. So when you're, again, reviewing your credit report, if there are payments mistakenly labeled as late, you want to get that taken care of. If you've been paying current for the life of the loan and it shows that something has been late, you want to dispute that. If there are accounts that are still open that should have been closed, you want to dispute that. Report mistakes right away. Those errors could lower your scores and cost you money. I was working with someone a couple years ago, and she had $8,000 as duplicate items on her credit report. And of course, that was costing her a credit score, not necessarily money, because she wasn't going to pay those, but it was showing as a detriment to her credit score. So we got those disputed, and that increased her score. Put your complaints in writing. If the issue still doesn't get resolved, you can write a letter to the Consumer Finance Protection Bureau, and that request can become part of your report. So whenever your report is run, they'll see that issue that was unresolved. So they can say, oh, okay, I saw that was an issue, it wasn't resolved, and they're not going to hold that against you. Okay, so how do you repair your credit, improve your score? It's going to take some time. Okay, it's going to take some patience, it's going to take some discipline, but as long as you continue to pay attention and stay in the game, then your credit score will increase over time. So just a couple of steps here. Check your credit reports for errors. Pay your bills on time. If you know that that's an issue for you, you might want to consider setting up automatic payments, set up payment reminders. Make sure those payments are going through if you set up automatic payments. If you have missed payments, get current as soon as possible. Contact your creditor if you're having an issue with paying things on time. Maybe they can lower what you have to pay every month, so that way you're still showing as current and paying. If you are looking at your credit report and you have a collection account, and you pay off that collection account, it's still going to stay on your report for 7 years. It'll show that it was paid, but it'll still be on your credit report. And that's okay because it shows that it's paid. And then number 3, reduce the amount of debt you owe. So pay off your debt instead of moving it from one credit card to another credit card because you have 0 interest. If that's going to save you money, move it from one credit card to the next, but then make a plan to pay off that debt instead of moving it to a 3rd credit card. Keep your balances low. Don't close unused credit cards because that's going to, if you want to do that as a short-term strategy, you don't want to do that because it's going to decrease the length of your credit history. It's also going to maybe increase your utilization percentage because now you have less of an available balance, and that's going to increase your percentage. And then again, don't open several new credit cards just to increase your available credit because that's going to be a ding showing that you're trying to open new types of credit. So one last thing, we have a success story here. There was a gentleman named Mr. Butler. He finally sat down during COVID. He said, you know what? I need to get my credit score in order. Now, this is something that, let's say you're thinking about right now, something that could happen in the future. His credit score was 520. So he sat down and he looked at his delinquent bills. He has medical bill, credit card, a car payment, student loans. All these things are late. So he said, I need to make a change. So he set up an auto payment for his loan and his credit cards so he doesn't miss any more bills. And again, it's not going to happen overnight. Like after he makes that first payment on time, it's not going to automatically increase his score, but it's going to eventually over time in the next maybe 6 to 8 months increase. And in his case, it did. 8 months, his credit score went up 160 points. And now his credit score is 775 by continuing to do those small but correct things over time. So the lesson to his story is you pay your bills on time. That accounts for 35% of your credit score. I would also suggest maybe paying your bills even before the due date. So your billing cycle says that your bill is due on the 2nd of the month. Why not try to pay it on the 30th of the previous month? And that's going to help your score to improve. Again, setting up those auto payments is great, but then you also have to check to make sure those monthly payments are being processed, because if for some reason your payment doesn't go through, boom, there's that ding, and let's say you've been paying on time for 4 months and then you get one missed payment. Well, that you might lose, 20, 40 points just because of that mistake. And it wasn't necessarily your mistake, but it was because you didn't make sure that it was paid on time. So it can be done if you want to improve your credit, if you want to get better credit, maintain your good credit. These are steps to do that. So, and you have my contact information, but I'll just stick it up here again, my phone number, and then the 2 email addresses that I have. So I'm gonna go ahead and stop sharing. All right. Any questions, Jason?
Not really. I think we've kind of touched base on some of this during my term, and then during the course of this session, I am working on bettering my credit.
Okay.
I'm currently paying on a credit card now,